There are many draws to trading the currency markets, which has really made it the most marketed trading vehicle for trading systems. As a retail trader, you can get started with an initial deposit so low that it's virtually unheard of in any other markets. You add in the 24-hour nature of the market and the vast combination of currency pairings, it draws in people from all backgrounds, experience, and expectation levels. With visions of fortunes dancing in their heads, people open an account, and for some, they are trading within days of depositing the required sum. Some hard facts are out there, and the most important is the number of people that actually succeed. Now, there are so many reasons why the majority fail at trading, and you may find yourself guilty of some of them. Many people use the EA, the expert advisor method, to reach their expectations of riches. There are the signal services that may or may not have a track record, but they don't really teach you how to fish. There are bogus strategies marketed that contain the secret code released from a profitable hedge fund manager. People use the professional forum posters for tips and strategies without asking if they can back up their trading claims. Even with good intentions, some just are not cut out for trading, even though they have a proven trading method right in front of them. And I don't want to discuss what I just mentioned. Although they are serious, there is one that will devour even the most conscientious trader. And I want to discuss what I like to call the silent killer, because oftentimes before you realize you're guilty of it, the damage has already been done. Well, guaranteed that since the first day you found out about the spot Forex trading opportunities, you were greeted with how great a 24-hour market was. You could find trading opportunities any time of the day. You saw the potential that was offered to you through the various sessions and through clever marketing. You nailed down a strategy, a risk profile, and you bounced off to day trade your account. And you decided that your $2,000 account at 2% risk allowed you an actual dollar risk per trade of $40. Your strategy averaged about 20 pips per trade risk, so you could trade about $2 a pip or 2 mini lots. And this is where the problem starts. You want to average $500 a week, so you needed to net after trade cost and minus the losing trades about 250 pips or 50 pips a day. You traded the London session, but it was full of news spikes and you had a really tough time of getting anything going. No problem, you said, as you knew you were about to head into the overlap session. So the U.S. trading session, it opens, and along with the London session still being active, you wanted to harness that power to see if you could bag a winner or two. Well, later that night, and with your kids tucked into bed, you could tackle the Asian session. After all, with only $2 a pip, you needed to average 50 pips a day to make any real money. Spread costs are putting in the hole about $4 as soon as you enter a trade, win or lose. And suddenly this freedom from a job has become a chain linking you to your desk as you begin to overtrade and churn your account. So why did this happen? After being bombarded with $1,000 claims, making $40 on a trade seems like nothing. Actually $38 because the broker does need to get paid. With your small trading account, you actually need to trade more often to make a real shot at making the big money. Or so you tell yourself, because you equate more trades with more wins, which equals more money. The entire trading world has seen some really crazy moves in the currency markets over the years, and that's something that you want to take advantage of. Remember, though, that those who look at a more macro view understand that there is more to trading than just moves on a chart. Even with the wild events that happen in the markets, you still must stick to a trade plan, and preferably the plan that came with your trading system that has a positive expectancy. It's far too easy to deviate from that plan and overtrade when you see the huge moves. There's always money to be made trading, but you must be around to take some of it. So starting with a smaller account and weathering the string of losses that always come, you're not allowing that magic of compounding to work. And I appreciate that the slow grind to the top is not fun, nor is it pretty. People get frustrated with the lack of progress, even if they are further ahead than they started, and they start doubling up, grabbing trades outside of their plan, not abiding by their stops since the market will always come back. Instead of patience and slow growth, they toss a mathematically proven formula aside for the next winner. No, see, the progress is too slow for them. So in the end, they short-circuit the process that's allowed many people to increase their account size, increase their position size, and finally reap the benefits of larger dollar amount winners. Now, one turning point for myself and other traders was when each pip actually meant something. I found that a smaller account was like using training wheels to ride a bike. A fall here or there never really hurt except maybe a few bruises. Well, the problem was a $20 loss was no big deal. getting sloppy even after a run of solid trading habit performance would happen. It wasn't until I pulled back and said to myself, treat this as if it were the only trading stake you'll ever have, that things changed. In my mind, each pip was greater value than what the account stated. Even went as far as to write an investor's report at the end of each week. Even though I was the only one with the money in the account, it was an exercise in learning to be a professional. When you actually write a review of yourself and account performance, it forces you to be critical. It forces you to face issues that could seriously destroy your trading career, especially if you're overtrading. See, it wasn't an actual increase in pip worth, but the perceived value of each pip. Each pip was a learning experience. It's a lesson. Each pip taken from the market with a professional mindset was worth more than any actual dollar worth. The opposite was the same as well. And you may say, well, this is too simplistic. Well, maybe so, but does it work? Worked for me and many others that this has been suggested to. At the end of the road lies the opportunity to have a position size that allows a greater payoff for fewer pips. Believe me when I say that before you increase your account size through your deposits, increase it in your mind first. You do not want to be at the beginnings of a learning experience when each pip is worth between $10 and $30. And you'll be shocked at how freeing it is to not only have 30 pips make you what takes people a week to make, but to do so with less time on the screen. And the great thing is that greater size does not equate to greater stress. It's really the opposite. There's less stress knowing that you don't have to peek at the market every hour to see if a trading setup is there. There's less stress knowing you only need that one nice bounce to end your day. Your level of patience increases because you don't have to perform or jump into every trade. And overtrading has ruined many traders trying to make a living in the markets. If you start off properly, overtrading will not be your downfall. Perceive a higher pip value with a professional approach, and you really do stand a greater chance of actually getting the higher value. And believe me, there are a host of other issues that are harder to rectify than this simple problem of overtrading. And overtrading is not going to make you rich, but your broker is certainly going to love you.